For 20 years, one man ran the largest fraud in American history, and almost nobody caught it. Not the investors, not the regulators, not even the people working directly for him. When it finally collapsed, $65 billion in supposed wealth turned out to be nothing more than numbers on a screen. This is the story of Bernie Madoff and how you actually get away with the biggest lie in Wall Street history for 2 decades straight. Bernie Madoff wasn't some outsider running a shady operation in the shadows. He founded his firm, Bernard L. Madoff Investment Securities, back in 1960, and by the 1990s, he was one of the most respected men in American finance. He served as chairman of the NASDAQ Stock Exchange. His client list included celebrities, universities, and charitable foundations. When people talked about trustworthy money managers on Wall Street, Madoff's name came up constantly. That reputation wasn't incidental to the scheme. It was the entire mechanism that made it work. Here's how a Ponzi scheme actually functions, because the concept is simpler than people assume. Instead of investing client money the way he claimed, Madoff simply deposited it into a single account and used funds from new investors to pay fake returns to earlier ones. No stock picks, no trades, no actual investment strategy at all. He told clients he was using something called a split strike conversion, a real but complex option strategy to justify consistent returns. Investigators later found he wasn't executing that strategy, or really any strategy. He was just moving money around and printing fake account statements that showed whatever numbers would keep people happy and keep new money flowing in. And that consistency was the trap. Madoff's returns weren't wildly high, which is exactly what made them so believable. He reported steady gains, somewhere around 10 to 12% a year, year after year, regardless of whether the broader market was up or down. Real investments don't behave that smoothly. Markets crash, correct, and swing. But Madoff's numbers just kept climbing in an almost perfectly straight line. And for 2 decades, that eerie consistency read as skill rather than fabrication. The scheme needed one thing to survive: a constant flow of new money coming in to pay off the people trying to take money out. As long as more cash was flowing in than flowing out, nobody had any reason to look closer. It's the same basic mechanic behind every Ponzi scheme in history, just operating at a scale nobody had attempted before, quietly running for roughly 20 years inside one of the most heavily regulated financial systems on Earth. Then came 2008. As the global financial crisis hit, panicked investors across the board started pulling their money out of everything, including Madoff's fund. Suddenly, he was facing about $7 billion in withdrawal requests, money he simply didn't have because it had never actually been invested anywhere. It existed only as numbers on client statements. On December 10th, 2008, Madoff confessed to his own sons that the entire business was, in his words, one big lie, basically a giant Ponzi scheme. His sons contacted a lawyer that same night. The next morning, federal agents arrested him at his Manhattan apartment. The final numbers were staggering. Client account statements showed a combined $65 billion in holdings. Court-appointed investigators later determined the actual cash investors had put in and loss totaled closer to $18 billion, with the rest being entirely fictitious profits that existed only on paper. Madoff pleaded guilty to 11 federal felonies in March 2009 and was sentenced to 150 years in prison, the maximum allowed by law. He died in federal custody in April 2021 at 82 years old. But the fallout didn't stop with Madoff himself. His son Mark took his own life in 2010. On the 2nd anniversary of his father's arrest, investigators eventually recovered more than $13 billion of the estimated losses by liquidating Madoff's assets, including properties and a 55-foot yacht, and redistributing that money back to victims, an unusually high recovery rate for a fraud of this size. Here's what makes this story genuinely unsettling rather than just a cautionary tale about greed. The Securities and Exchange Commission received multiple credible tips about Madoff over the years, including detailed mathematical analysis from an independent financial analyst, laying out exactly why his returns were statistically impossible. They investigated multiple times, and they missed it every single time for years because Madoff's reputation and connections made the fraud almost unthinkable to the people supposed to be watching for it. That's really the core lesson underneath all of this. The scheme didn't survive on complexity. It survived on trust, consistency, and the simple fact that nobody wants to be the person who accuses. A Wall Street legend of running a con. Madoff wasn't a genius. He just understood, better than almost anyone in history, exactly how far reputation alone could carry a lie before anyone thought to check. If you want to see another story about a financial empire that looked unstoppable right up until the moment it collapsed, go watch our video on the Hunt brothers and the silver market crash next, and subscribe if these deep dives are your thing.